In 1998, one of the most astonishing failures in the history of modern finance unfolded behind the doors of a Manhattan skyscraper. The story of long-term capital management, LTCM, a hedge fund once valued at $4.6 billion, is one of the most captivating cautionary tales of financial markets. It is the story of a group of brilliant minds who, armed with mathematical models and academic brilliance, sought to master the world of global finance, only to see their empire crumble in the blink of an eye, shaking the very foundation of Wall Street. But what exactly happened? How could a fund, built by Nobel laureates and some of the brightest minds in the world, collapse in such spectacular fashion? And why is this story still so relevant in today's fast-paced, digital-first financial ecosystem? The genius behind LTCM was undeniable. The fund was founded by John Meriwether, a former Salomon Brothers bond trader, along with a group of financial whiz kids, including 2 Nobel Prize winners, Myron Scholes and Robert Merton. Their strategy was groundbreaking, using mathematical models to predict the movements of the financial markets with near absolute certainty. It was a revolutionary idea, but, as we would come to learn, a dangerously flawed one. LTCM strategy hinged on the concept of arbitrage, the belief that in an efficient market, there would always be small pricing discrepancies between related financial instruments, which could be exploited for risk-free profit. Their sophisticated models and unparalleled computing power allowed them to take massive positions in the market, leveraging billions of dollars in assets to make a few percentage points of profit on small movements. At its peak, LTCM was operating with a kind of influence and confidence that only the most elite hedge funds possess. But their success was built on a fragile foundation. The models they relied on were based on historical data that could not foresee the possibility of extreme events, the kind of rare black swan occurrences that could disrupt the entire system. When the Russian financial crisis hit in 1998, LTCM's models proved useless, and the fund's massive positions began to collapse under the weight of global economic turmoil. The consequences were disastrous, not just for the fund itself, but for the entire financial system. LTCM's failure had the potential to send shockwaves through the global economy, threatening to destabilize the financial markets in ways never seen before. The fallout from this collapse led to one of the most significant government bailouts in history, as the Federal Reserve and major Wall Street banks intervened to prevent a total meltdown. The story of LTCM's rise and fall is more than just a tale of financial hubris. It is a warning about the dangers of overconfidence, the limits of mathematical models, and the perils of excessive leverage. But while the specifics of the LTCM story may seem like a relic of the past, its lessons are more relevant today than ever before. In a world where financial markets are driven by algorithms, where the rise of meme stocks and crypto hype cycles dominate the headlines, and where retail traders armed with nothing but smartphones and social media influencers can sway entire markets, the LTCM saga serves as a timeless reminder of the dangers of hubris, the unpredictability of markets, and the crucial importance of managing risk. We live in a time where the trading psychology that LTCM's managers once displayed is eerily familiar. Today, we are surrounded by FOMO culture, where investors chase quick profits and gamble on assets with little regard for risk. The rise of meme stocks and cryptocurrencies, where valuations can skyrocket on nothing more than viral social media posts, mirrors the same kind of reckless speculation that LTCM engaged in. Social media and platforms like Robinhood have democratized investing, but with that democratization has come a new kind of financial fragility, as millions of individual investors make decisions based on fear and greed, rather than sound financial principles. The era of zero-commission trading has made it easier than ever for anyone to dive into the market. But with this ease comes profound lack of understanding about the underlying mechanics of finance. The FIRE movement, financial independence, retire early, with its focus on frugality and investing in low-cost index funds, stands in stark contrast to the kind of high-risk, high-reward strategies that LTCM employed. Yet, both are part of the same financial ecosystem, one that is now more interconnected, faster moving, and volatile than ever before. The rise of financial influencers on YouTube, TikTok, and Twitter further complicates the picture. Today's retail investors are exposed to an endless stream of advice, some of it well-informed, but much of it driven by hype, emotion, and sensationalism. In many ways, this mirrors the atmosphere of unchecked risk that surrounded LTCM, A group of people with more confidence and understanding, using leverage and models that seemed foolproof but were doomed to fail when reality intervened. In When Genius Failed, Roger Lowenstein takes us through the collapse of LTCM with a blend of journalistic rigor and storytelling mastery. He explores the personalities behind the fund, the errors in judgment, and the ripple effects that the fund's failure had on the global financial system. Lowenstein's work serves as both a detailed history and a cautionary tale for anyone involved in the financial markets today. What makes Lowenstein's account so valuable is not just its historical significance, but its lasting relevance. As we navigate an increasingly volatile financial world, where artificial intelligence, algorithmic trading, and social media influence play an ever-growing role, LTCM's collapse offers a crucial lesson in risk, humility, and the limits of human knowledge. As we move deeper into the story of LTCM, we'll break down the events that led to its rise and fall, analyze the financial strategies that led to its implosion, and draw lessons that resonate with modern-day investing. The story of LTCM is far from just a cautionary tale for bankers and hedge fund managers. It is a timeless lesson for every investor, from retail traders on Robinhood to the most seasoned professionals on Wall Street. The collapse of LTCM may have been a singular event, but its implications reverberate through the financial markets to this very day. In the end, it serves as a reminder of the fundamental truth of investing. No matter how sophisticated the models, no matter how confident the investors, the market always has a final say. Great. Let's dive into the first chapter of When Genius Failed by Roger Lowenstein, the formation of LTCM. I'll provide a detailed breakdown, ensuring it's rich in narrative, educational insights, and modern connections. Chapter 1. The Formation of LTCM. In the early 1990s, on the gleaming streets of Manhattan, a group of financial elites came together to form a hedge fund that would quickly become the envy of Wall Street. The story begins with the figure of John Meriwether, a trader whose name was already synonymous with risk, brilliance, and success. Meriwether had earned his reputation at Salomon Brothers, where he had managed a bond trading desk and brought in billions of dollars in profits. Yet, despite his success, Meriwether left Salomon after a scandal involving government bond market manipulation. But, as with many financial prodigies, he wasn't about to fade into obscurity. Instead, he envisioned something even more ambitious, even more daring. Meriwether wanted to build a hedge fund that would not only profit from the fluctuations in global markets, but would also be guided by an intellectual approach that was completely different from anything the finance world had seen before. He saw an opportunity to marry academic rigor with the raw power of capital markets. This is where the genius of long-term capital management, LTCM, began to take shape. Meriwether's vision for LTCM was not one driven by gut instinct or even by traditional market analysis, but by something much more scientific: mathematics. Meriwether, a former bond trader, understood that the financial markets, despite their volatility, operated within certain measurable patterns. These patterns, he believed, could be captured using complex mathematical models that would predict how different financial instruments will behave under various market conditions. He recruited a team of some of the brightest minds from the world of academia. The two Nobel laureates, Robert Merton and Myron Scholes, were brought in to help design the fund strategies. Scholes and Merton, famous for their work on the Black-Scholes model, which is a backbone of modern options pricing, were celebrated for their deep understanding of financial theory. Along with them came other key figures, including PhDs in economics, finance, and physics, all of whom were experts in the emerging field of quantitative finance. With their academic credentials and Meriwether's trading savvy, LTCM was born. LTCM's strategy, on paper, seemed almost foolproof. The fund was based on the idea of arbitrage, exploiting small price discrepancies between related financial instruments, such as bonds, stocks, and derivatives. These opportunities were thought to be so small that even if the positions didn't pay off immediately, they would in time. The fund's models assumed that, in the long run, these discrepancies would narrow, allowing LTCM to profit from a process known as convergence. It was a strategy that minimized risk and maximized returns by using leverage, borrowing money to increase the size of their positions. In simple terms, LTCM's strategy was to bet on the future convergence of prices while using borrowed money to amplify those bets. They used financial derivatives to hedge risks, And their models told them that, in most cases, these trades would eventually pay off, as long as the market stayed relatively stable. As the fund grew, LTCM's reputation blossomed. Their success seemed to confirm the brilliance of their mathematical models. In fact, by 1993, LTCM had attracted billions in investments from some of the wealthiest institutions in the world. At its peak, the fund was managing over $4.6 billion in assets, and its operations were global, stretching from bond markets in Europe to currency markets in Asia. But it wasn't just the academics who made LTCM special. The fund's backers included some of the most influential figures in finance. The people behind LTCM were not only brilliant, they were well-connected. Merriweather had managed to attract a group of investors that included some of the most powerful banks and financial institutions, creating a network that would support the fund's growth and, ultimately, its failure. There was, however, an underlying problem. This level of sophistication also masked a fundamental risk. While the models used by LTCM had proven successful in the past, they were built on historical data, assumptions that the world of finance would remain relatively stable, that market volatility would behave in predictable patterns. In fact, these models assumed that financial crises were extremely rare and that the risk of major market disruptions was nearly non-existent. But financial markets are never as predictable as they seem. As LTCM began to scale, its leverage grew exponentially. The fund used borrowed money to amplify the size of its bets. This created an environment where small errors in judgment could result in catastrophic losses. But for a time, LTCM's success made these risks seem manageable. The models worked, the market responded, and the fund generated enormous profits. LTCM's strategy was highly reliant on the global bond market and government securities. They believed in the principle of mean reversion, the idea that financial prices would always move toward a long-term average. But as LTCM grew, they became so successful at exploiting these discrepancies that they started to take on positions that were far too large for the market to bear. By 1997, LTCM had pushed its strategy to the extreme, with hundreds of billions of dollars in derivatives and trades. The fund had taken positions so massive that the market itself could not absorb the trades without moving prices. In essence, LTCM was becoming a key player in the global financial system. This was the beginning of the end for LTCM. In modern terms, LTCM strategy is not entirely dissimilar to the strategies employed by high-frequency traders, algorithmic trading funds, and hedge funds today. These funds rely on complex algorithms to exploit minute pricing discrepancies in markets, all while using leverage to maximize returns. But as we've seen in the years since LTCM's fall, these strategies are highly vulnerable to unexpected shocks in the market, especially when they rely on historical data and mathematical models that fail to account for black swan events. Today, the strategies employed by LTCM are still seen in the world of quantitative finance, but with a crucial difference. The lessons learned from LTCM's collapse have made many investors more cautious. The rise of meme stocks, the wild swings in cryptocurrency prices, and the increasing use of options and leverage in retail trading are reminders that, for all the mathematical models in the world, financial markets are still subject to human psychology and unforeseen events. The world of LTCM may have been about complex math and theoretical models, but today's markets are about more than just formulas. They are about the forces of social media, FOMO culture, and the masses of retail investors making their trades based on the latest meme stock or the next crypto trend. Yet, the fundamental truth remains: excessive leverage, unchecked risk, and overconfidence will always lead to market instability. Chapter 2: The World of High Finance and Theories Behind LTCM Success. Long-term capital management, LTCM, was not simply another hedge fund. It was a bold experiment in applying academic theory to the world of high finance. This was an era when Wall Street was beginning to embrace quantitative analysis and sophisticated financial models, ideas that had been developed in the ivory towers of academia, but had yet to be tested on the global stage. LTCM's founders believed they had uncovered the secret formula to consistently win in the markets, and they were determined to prove it. At the heart of LTCM's strategy lay the groundbreaking work of Myron Scholes and Robert Merton. Both had been awarded the Nobel Prize in Economics in 1997 for their development of the Black-Scholes model, a formula used to price options and other derivatives. The Black-Scholes model had revolutionized the way traders understood and priced risk in financial markets. It was based on the belief that financial markets were relatively efficient, meaning that prices reflected all available information and that market volatility could be measured and predicted using statistical models. The idea was simple. By applying these models to global financial markets, LTCM could predict price movements and capitalize on the small discrepancies between related financial instruments. These were known as arbitrage opportunities, situations where two assets, which should be related in price, were temporarily mispriced. By borrowing vast sums of money and investing in these mispriced assets, LTCM could generate risk-free profits, or so the theory went. The core of LTCM's philosophy was based on two key principles: mean reversion and arbitrage. Mean reversion is a belief that prices of financial assets tend to move back toward their long-term averages over time. For example, if the price of a bond or a currency became temporarily mispriced due to market sentiment or short-term events, LTCM's models assumed that it would eventually revert to its fair value. Arbitrage, on the other hand, was a practice of taking advantage of these mispricings, buying undervalued assets and selling overvalued ones, in the hopes of earning a profit when the prices converged. In essence, LTCM was betting that financial markets, despite their occasional volatility, would always return to a state of equilibrium. The fund's managers believed that if they could identify and exploit these discrepancies before anyone else did, they could generate consistent returns with minimal risk. It was a strategy rooted in confidence, logic, and the power of mathematical models. The strength of LTCM's strategy was not just in its ability to identify arbitrage opportunities, but in the sheer scale at which it operated. The fund employed leverage, borrowing money to amplify its investments in a way that few others had dared to do. While many hedge funds use leverage to a certain extent, LTCM took it to an extreme. The fund borrowed vast sums of money from major banks and financial institutions, using this capital to take large positions in the global markets. At its peak, LTCM was managing more than $100 billion in assets, but only $4.6 billion of that was actually its own capital. The rest came from borrowed funds, a practice known as leverage. In theory, this leverage would amplify LTCM's profits. A small mispricing of a financial asset could yield huge returns when leveraged many times over. However, as we will see, this same leverage would prove to be the fund's Achilles heel when things went wrong. To execute its strategy, LTCM relied heavily on a vast network of trading algorithms and computer models. These models were designed to predict the future movements of financial markets based on historical data. The fund's managers believed that the mathematical formulas they had created were so powerful that they could accurately predict future price movements with almost surgical precision. By using these models, LTCM could calculate exactly how much risk they were taking on any given trade and adjust their positions accordingly. The models were also designed to manage risk by ensuring that the fund's exposure to any single asset was kept within predetermined limits. LTCM's reliance on computers and models gave the fund an almost mythical status in the financial world. Wall Street traders and investors marveled at LTCM's ability to generate returns that were consistently higher than the market averages. The fund's backers included some of the most powerful institutions in the world, including major banks like Goldman Sachs, Deutsche Bank, and Merrill Lynch. The confidence that the market had in LTCM's approach was palpable, and the fund's name became synonymous with success and intellectual brilliance. However, LTCM's rise to power was not without its critics. Some seasoned investors warned that the fund was too reliant on its models, that its mathematical approach was overly simplistic, and that it ignored the unpredictable nature of markets. But for every skeptic, there were many more who saw LTCM's strategy as the future of finance. After all, the fund's performance during its early years was nothing short of extraordinary. Between 1994 and 1997, LTCM generated annual returns of 40% or more, consistently outperforming the market and attracting more and more capital. As LTCM's success continued to grow, so did its influence. The fund became a major player in global financial markets, taking large positions in government bonds, currencies, and derivatives. Their trades were so significant that they began to move markets. This was no longer just a small hedge fund. LTCM was now a behemoth, with the power to sway global financial markets. But this growing influence would soon become a double-edged sword. The more money the fund borrowed, the larger its positions grew, and the more vulnerable it became to any disruption in the market. The models that had served LTCM so well were based on the assumption that markets were relatively stable, that the risks of extreme events, such as a market crash, were so low that they could be ignored. But the reality of financial markets is much messier. While LTCM's models were based on past data, they were blind to the possibility of extreme events, so-called black swan events, that could throw everything into chaos. In the world of high finance, LTCM was seen as a gold standard. Its success proved the power of quantitative finance, the ability to predict market movements using complex algorithms and vast amounts of data. But as LTCM's story would soon reveal, the market is an unpredictable beast, and no model, no matter how sophisticated, can account for every variable. Modern investing reflection. LTCM strategies echo the practices of modern-day quantitative hedge funds, high-frequency traders, and algorithmic trading systems that dominate today's financial markets. However, in an era where the rise of meme stocks, crypto bubbles, and social media-driven market movements reign supreme, we see the same dangers of relying too heavily on mathematical models without considering the irrational human behaviors that can drive markets. The same blind spots that plagued LTCM's approach, an over-reliance on historical data, excessive leverage, and underestimation of black swan events, are still seen today in the rise of automated trading systems, cryptocurrency speculation, and over-leveraged retail investing. In the current environment, platforms like Robinhood and the increasing use of leverage in retail investing make it easier for anyone to place bets on the market. But this democratization of finance comes with its own risks. The widespread use of zero-commission trading, combined with the power of social media to create FOMO, fear of missing out culture, leads many to engage in speculative, risky behavior, much like the behavior exhibited by LTCM before its collapse. As we continue to navigate this new age of finance, it's crucial to remember that while mathematics and models are powerful tools, they cannot predict the chaos of the markets, a chaos often fueled by the very human emotions that LTCM's models fail to account for. Chapter 3. The expansion of LTCM's influence. In the mid-1990s, long-term capital management, LTCM, was no longer just a small hedge fund managed by a handful of brilliant academics. It had evolved into a powerhouse in the world of finance. What started as a novel experiment in quantitative finance had rapidly morphed into a global juggernaut, a fund so powerful that it could move markets, influence policy decisions, and shake the very foundations of the global financial system. But as LTCM's influence grew, so did the risks it took on. By 1996, LTCM's assets had surged past $4 billion. It was managing billions more in borrowed money. Its aggressive trading strategies, based on complex mathematical models, were producing exceptional returns, fueling the fund's rapid expansion. With each passing year, LTCM became more entrenched in the world of high finance. The fund was not just executing trades on global markets, but actively shaping the market's direction. Its positions were so large that it had the potential to move entire markets with a single trade. To the outside world, LTCM was a financial oracle, an entity capable of seeing the future of finance with an uncanny precision. LTCM's operations were, on the surface, elegant and efficient. Its managers, armed with their groundbreaking theories, used mathematical models to predict the future prices of assets with remarkable accuracy. The fund had perfected the art of arbitrage, identifying and exploiting small price discrepancies in global markets, such as between related government bonds, currencies, and derivative instruments. In doing so, it sought to profit from market inefficiencies, with the assumption that, in the long run, prices would always converge toward their fair value. But the true scale of LTCM's operations was not immediately apparent to the public. Behind the scenes, the fund's leadership was leveraging its incredible returns to attract more and more institutional investors. Some of the world's largest banks and financial institutions, including Goldman Sachs, Merrill Lynch, and Deutsche Bank, were now backing LTCM. These institutions weren't just investing their money in LTCM strategy. They were also providing the massive amounts of capital the fund needed to make its trades. LTCM's influence continued to expand as it built an extensive network of relationships with financial powerhouses. Its managers were not only respected for their intellectual brilliance, but they were also deeply connected in the world of high finance. The fund's backers were made up of some of the wealthiest and most powerful players in the financial world, including major pension funds, insurance companies, and sovereign wealth funds. These investors viewed LTCM as a kind of sure bet, trusting in the fund's model and its brilliant leadership to generate consistent returns. But LTCM's rise to dominance was not just about the money it made. It was also about the influence it wielded. By 1997, LTCM had grown so large that its trades were influencing the global financial markets. The fund was not only taking massive positions in U.S. Treasury bonds, but also in global currency markets, emerging market debt, and other financial instruments. Its enormous trading volume made LTCM a major player in these markets, with the ability to move prices simply by executing its trades. The fact that LTCM had so much capital and so many high-profile backers gave it an air of invincibility. The fund's managers believed that they had perfected the science of investing, and as their success continued, they became more confident in their ability to predict market movements. They operated under the assumption that the models they created were infallible, that they could handle any fluctuations in the market, and that the risks they were taking on were minimal. LTCM's increasing leverage was key to its success. The fund used borrowed money to amplify its positions, allowing it to take on enormous trades that would have been impossible without leverage. The more leverage LTCM used, the greater its potential for returns. But it also meant that the fund's potential for losses was multiplied. If the models that LTCM relied on proved to be incorrect, the consequences would be catastrophic. To make matters worse, LTCM's leverage was not just about borrowing money from traditional sources like banks. The fund had begun to borrow directly from other hedge funds and financial institutions, creating a web of interconnectedness between major players in the financial system. The problem with this approach was that if one part of the web were to break, it could have a domino effect, causing the entire system to unravel. As LTCM's influence grew, so did its willingness to take on risk. The fund strategy was based on the assumption that markets will remain relatively stable. But as LTCM began to take on more leverage and expand its positions, it was effectively betting against the possibility of major market disruptions. This was a bet that seemed increasingly foolish as the world entered a period of unprecedented global instability. In 1997 and 1998, financial markets began to experience heightened volatility as emerging markets struggled with debt crises, and the Russian economy teetered on the brink of collapse. LTCM had massive exposure to these emerging markets, and the fund's models began to show cracks. The markets were no longer behaving as LTCM's models had predicted. Instead of converging to a fair value, asset prices began to diverge in ways that were not accounted for in the fund's models. The risk that LTCM had taken on was now becoming clear. The fund had become so large and its position so entrenched in the global financial system that a failure would have ripple effects that could bring down major financial institutions. The more LTCM's influence grew, the more it exposed itself to the possibility of catastrophic losses. Modern investing reflection. The expansion of LTCM's influence mirrors the dynamics of today's financial ecosystem, where hedge funds and institutional investors exert significant control over global markets. In the modern era, the rise of passive investing, the dominance of exchange-traded funds, ETFs, and the power of algorithmic trading have created similar networks of interconnectedness and influence. The larger these funds become, the more they shape the markets they trade in, and the more dangerous their collapse would be. Today's financial system has become even more interconnected than LTCM's time, with retail investors now able to take massive positions in stocks and assets through platforms like Robinhood. The rise of meme stocks, fueled by social media-driven hype, demonstrates how the influence of collective behavior can move markets in unpredictable ways. However, just as LTCM's managers believed their models were infallible, many retail investors today are making similar assumptions, driven by the assumption that trends will continue indefinitely or that the market will always bounce back. LTCM's use of leverage also has a direct parallel in today's market. The growing popularity of margin trading, the proliferation of options contracts, and the use of leveraged ETFs all echo the same patterns of excessive risk-taking that led to LTCM's downfall. While the tools have evolved, the underlying risks remain the same: the temptation to use borrowed money to amplify gains without fully considering the consequences of failure. The key takeaway from LTCM's rise and the expansion of its influence is that size and power in the financial markets are not guarantees of success. As history has shown, the bigger the bet, the bigger the potential for disaster when things go wrong. The interconnectedness of global financial markets means that even small disruptions can send shockwaves throughout the system, just as LTCM's collapse nearly did. Chapter 4. The Fall of LTCM. It seemed inevitable, though it wasn't always clear when or how it would happen. Long-term capital management, LTCM, a hedge fund once thought to have cracked the code of the financial markets, had built its empire on a simple belief that markets, in the long run, were predictable and stable. They assumed that even during market volatility, the vast majority of mispricings would eventually correct themselves, offering a safe, risk-free path to profits. But as the fund grew larger, its strategies grew riskier, its leverage more reckless, and the financial world began to show signs of an impending storm. The collapse of LTCM didn't happen overnight. In fact, the early signs of trouble were subtle, almost imperceptible. In the years leading up to the crisis, LTCM had continued to generate impressive returns, but those returns were increasingly driven by the same core strategy: high leverage, massive bets, and the belief that the world's markets would remain relatively stable. But in 1998, a series of unforeseen events began to hit global financial markets. Events that LTCM's models had never anticipated. The first and most significant shock came in August 1998, when the Russian government defaulted on its debt and devalued its currency, sending shock waves through global markets. For LTCM, the consequences were devastating. The fund had large positions in Russian bonds and other emerging market debt, expecting that these assets would converge to their fair value over time. But when Russia defaulted, the value of these assets plummeted, and LTCM found itself sitting on massive, unmanageable losses. The models that had worked so well for LTCM in the past suddenly failed to account for the extreme volatility that accompanied the Russian financial crisis. At first, LTCM's managers believed the market was simply experiencing a temporary blip, and that the prices would eventually stabilize and revert to their expected levels. But as the days and weeks wore on, the situation grew worse. As LTCM's losses mounted, the fund was forced to sell off its positions to cover its margin calls. But selling assets in a collapsing market only pushed prices even lower, triggering a vicious cycle of forced liquidations. The leverage that had once amplified LTCM's profits now amplified its losses. The fund had borrowed enormous amounts of money to build its positions, and with a sudden drop in asset prices, it no longer had the capital to meet its obligations. In an instant, LTCM found itself caught in a liquidity trap, unable to sell its positions without incurring further losses, and unable to raise enough capital to cover its debts. As the situation deteriorated, LTCM's managers began to panic. They realized that the fund was facing an existential crisis, one that could not be solved with their traditional models or mathematical expertise. The fund's backers, including some of the most powerful banks and financial institutions in the world, grew increasingly nervous. The fear wasn't just about LTCM's collapse. It was about what would happen if LTCM's collapse triggered a broader financial crisis. The reality of LTCM's situation soon became clear. The fund was too big to fail. Its massive positions were deeply embedded in global markets, and its failure could cause a chain reaction that would destabilize the entire financial system. The question was no longer whether LTCM would collapse, but whether the rest of the financial world could prevent the damage from spreading. In September 1998, the Federal Reserve, under the leadership of Alan Greenspan, stepped in to broker a rescue deal for LTCM. The Fed was concerned that if LTCM were allowed to fail, it could trigger a panic in the global financial system, leading to widespread losses and potentially a full-blown financial crisis. To prevent this, the Fed facilitated a bailout of sorts, with a consortium of major banks and financial institutions agreeing to inject capital into LTCM and take control of its assets. The rescue deal was a turning point in the story of LTCM's collapse. The fund had once been a symbol of financial genius, a testament to the power of mathematical models and quantitative finance. But in the end, it was not mathematics that saved LTCM. It was the intervention of the very financial institutions that had enabled the fund's reckless risk-taking in the first place. The bailout allowed LTCM to avoid total collapse, but also revealed the deep interconnectedness of global finance and the dangers of relying on highly leveraged, interconnected financial institutions to maintain stability in times of crisis. But even after the bailout, LTCM's downfall continued to reverberate through the financial world. The collapse of LTCM revealed the inherent dangers of excessive leverage and overconfidence in financial models. It exposed the fragility of the financial system and the risks of assuming that markets will always return to equilibrium. More importantly, it demonstrated that no amount of intellectual brilliance could protect investors from the unpredictable nature of financial markets. In many ways, the collapse of LTCM can be seen as the first great warning sign of the risks of modern finance. The fund's reliance on complex models, its massive use of leverage, and its overconfidence in the predictability of markets mirror the behavior of many financial institutions in the years leading up to the 2008 financial crisis. The story of LTCM was, in many respects, a precursor to the larger collapse of the global financial system a decade later. Modern investing reflection. The collapse of LTCM mirrors many of the same patterns we see in today's financial markets. The use of leverage, reliance on quantitative models, and the assumption that markets will always return to equilibrium are all still prevalent in modern investing, especially in the realm of high-frequency trading, cryptocurrency speculation, and leveraged exchange-traded funds, ETFs. The events of 1998 are eerily similar to the run-up to the 2008 financial crisis, where excessive risk-taking, poor risk management, and reliance on flawed models led to a catastrophic collapse. But perhaps the most relevant lesson from LTCM's fall is the risk of overconfidence in financial models. Today, financial technology, from robo-advisors to algorithmic trading, has democratized access to sophisticated investment strategies. Yet, the core mistake remains the same: assuming that past data and mathematical models can predict future events with certainty, without accounting for the full range of potential market disruptions. In today's world, where meme stocks can skyrocket based on nothing more than social media hype, and where a massive amount of capital can be moved by a tweet or a viral post, the collapse of LTCM serves as a reminder that markets are unpredictable. Even the most brilliant minds can be blindsided by the irrational forces of human psychology, fear, and greed. The fear that drove the rescue of LTCM, the concern that its failure would trigger a financial crisis, is something we see echoed today in the global interconnectedness of markets. The rise of algorithmic trading, crypto markets, and the explosion of passive investing all show how deeply intertwined the world's financial systems have become. The failure of one major player, whether in the form of LTCM or a cryptocurrency exchange, could ripple through the entire financial ecosystem, causing unforeseen consequences. The fall of LTCM teaches us that, no matter how sophisticated the models, the market can never be fully predicted. Understanding and respecting the limits of these models is crucial, particularly in an age where the very nature of investing is being transformed by technology. Chapter 5. The Rescue Effort. The collapse of long-term capital management, LTCM, in 1998 was more than just a failure of a hedge fund. It was a wake-up call for the entire financial system. As the fund's positions began to implode, it became clear that LTCM's influence was so vast, its interconnectedness with global markets so deep, that its failure could have catastrophic consequences far beyond the fund itself. What followed was not just a financial disaster, but a high-stakes rescue effort led by Wall Street's most powerful institutions, a delicate operation to prevent a full-scale financial meltdown. In many ways, the story of LTCM's rescue is one of paradoxes. The fund had been built on the idea of mathematical genius and academic rigor, a belief that markets could be tamed and understood through data and theory. Yet, when the time came to deal with its imminent collapse, it was not the models or algorithms that saved LTCM, but the willingness of major financial players to step in and prevent chaos. The sheer size of LTCM's positions, combined with its extensive use of leverage, meant that its failure could create a ripple effect throughout global markets. The fund's extensive holdings in government bonds, derivatives, and emerging market debt meant that if it were allowed to fail, the global financial system could experience a systemic breakdown. This reality was not lost on LTCM's investors, nor on the major banks and institutions that had supported the fund. The collapse of LTCM threatened not only to ruin the fund's investors, but also to cause a domino effect that could destabilize the world economy. It was this realization, the very real risk of a global financial crisis, that prompted the intervention of the Federal Reserve. Under the leadership of Chairman Alan Greenspan, the Fed played an instrumental role in orchestrating a rescue effort to prevent LTCM from going under. In September 1998, the Federal Reserve called a meeting with the key players in the financial industry to address the crisis. The Fed's involvement was not a direct bailout of LTCM. Rather, it acted as a mediator, guiding major financial institutions to form a consortium that would inject capital into LTCM and take control of its operations. The goal was to stabilize the situation by time and avoid the chaos that would ensue if LTCM were left fail. The consortium of banks that came together to rescue LTCM included some of the most powerful institutions in the world: Goldman Sachs, Merrill Lynch, Deutsche Bank, and JP Morgan, among others. These banks, along with other major financial players, agreed to contribute $3.65 billion to fund, which would allow it to meet its margin calls and prevent further liquidation of its positions. In exchange for this capital injection, the banks took control of LTCM's portfolio and began to unwind the fund's positions in a more orderly manner. While the rescue effort succeeded in stabilizing LTCM in the short term, it was clear that this was not a solution to the underlying problems. The intervention was a temporary fix, a way to buy time and prevent the collapse from spiraling into a full-scale financial crisis. But the broader lessons of LTCM's failure remained unaddressed. One of the most striking aspects of the rescue effort was the way it revealed the fragility of the financial system. LTCM was a hedge fund, not a bank, but its collapse posed a direct threat to global financial stability. The situation exposed the interdependence of financial institutions and the dangers of systemic risk. The risk that the failure of one large institution could trigger a chain reaction that would destabilize the entire system. The idea of too big to fail, which had once been confined to large banks, was now applied to a hedge fund, a fund that, just a few years earlier, had been seen as a symbol of financial genius and innovation. LTCM's rescue also raised questions about the role of government and central banks in managing financial crises. The Fed's intervention was controversial, with some arguing that it was inappropriate for the government to bail out a private hedge fund, particularly one that had been engaging in highly speculative and risky behavior. Others, however, believed that the Fed had no choice but to intervene, given the potential consequences of LTCM's collapse. At the heart of the debate was the issue of moral hazard. The idea that rescuing failing institutions could encourage reckless behavior in the future. The concern was that by stepping in to save LTCM, the Fed might be sending a message that financial institutions could take on excessive risk without facing the consequences, knowing that the government would step in to save them if things went wrong. This would, in theory, create a situation where financial institutions were incentivized to take on even more risk, knowing that they would be bailed out if their bets didn't pay off. But as we know, the lessons from LTCM's rescue were not fully absorbed. In the years that followed, the financial industry continued to engage in increasingly risky behavior, culminating in the 2008 financial crisis. The collapse of LTCM, along with the government's intervention, highlighted the dangers of excessive leverage, the risks of financial models that didn't account for real-world volatility, and the vulnerability of the financial system to systemic shocks. These lessons were forgotten by many, but not all. Some investors, like Warren Buffett, saw the signs and began to warn about the growing risks in the system. The rescue of LTCM also highlighted the growing role of risk management in global finance. The collapse underscored the need for financial institutions to understand and manage systemic risk, particularly in an interconnected world. But more than that, it revealed the limits of financial models and the fragility of the financial system itself. The rescue effort did not solve the underlying problems that caused LTCM's collapse. It merely postponed the inevitable reckoning. In many ways, the rescue of LTCM was a precursor to the events that would unfold a decade later. The 2008 financial crisis was triggered by many of the same factors that led to LTCM's downfall: excessive leverage, risky bets, and the failure to account for the possibility of extreme market disruptions. The difference, however, was that by the time the 2008 crisis hit, the global financial system was far more interconnected and far more vulnerable than it had been during the LTCM crisis. Modern investing reflection. The rescue of LTCM echoes the growing concerns we see in today's financial markets about systemic risk and the role of central banks in managing crises. In today's world, the growing influence of passive investing, algorithmic trading, and the use of leverage by retail investors has created a financial ecosystem that is even more interconnected and more fragile than it was in 1998. The rapid rise of retail investing platforms like Robinhood, the widespread use of margin trading, and the volatility introduced by meme stocks and cryptocurrencies all point to the increasing risks in today's markets. Moreover, the question of moral hazard is even more relevant now than it was during LTCM's rescue. The intervention of the Federal Reserve to stabilize LTCM in 1998 was just the beginning of a pattern of government interventions in financial markets that would become more common in the years that followed. In the wake of the 2008 financial crisis, the U.S. government and central banks around the world would step in with even more massive bailouts, further solidifying the too big to fail mentality. As the financial markets continue to evolve, the lessons from LTCM's rescue are more pertinent than ever. While the Fed's intervention prevented immediate disaster, it also highlighted the risks of an over-reliance on government bailouts and the dangers of systemic risk in an interconnected world. In today's markets, it's more important than ever for investors to understand the full implications of leverage, model-driven investing, and the role of central banks in times of crisis. Chapter 6. The Aftermath and Lessons Learned. When long-term capital management, LTCM, finally collapsed in the fall of 1998, the immediate aftermath sent shockwaves through global financial markets. The hedge fund's spectacular fall from grace had not only cost its investors billions of dollars, but it also revealed deep vulnerabilities in the financial system. In the aftermath, questions arose about the systemic risks posed by highly leveraged financial institutions, the dangers of over-reliance on mathematical models, and the ethical considerations surrounding government interventions in financial markets. The immediate financial consequences of LTCM's failure were staggering. The fund's collapse threatened to take down some of the world's largest banks and financial institutions. The intervention of the Federal Reserve and the rescue effort by major Wall Street banks had prevented a total collapse, but it didn't erase the damage already done. The financial system had been exposed to extreme levels of risk, and LTCM's collapse made it painfully clear that even the most sophisticated mathematical models could fail in the face of real-world market disruptions. Despite the rescue, the damage to LTCM's reputation was irreversible. The fund, once celebrated as a beacon of intellectual achievement and financial innovation, had become a cautionary tale for investors and financial institutions alike. The events surrounding LTCM's collapse underscored several crucial lessons that would resonate far beyond the immediate crisis and would continue to shape the world of finance for years to come. Lesson 1. The dangers of excessive leverage. One of the most glaring lessons from LTCM's downfall was the danger of excessive leverage. Leverage is a double-edged sword. When used prudently, it can amplify returns, but when used recklessly, it can magnify losses. LTCM had used leverage to build massive positions in global markets, borrowing vast sums of money to amplify its bets. The fund's success was built on the assumption that small mispricings in the market would correct themselves over time, allowing LTCM to profit with minimal risk. But when those mispricings didn't correct, when the market was hit by shocks like the Russian debt crisis, LTCM's leverage turned from a tool for profit into a ticking time bomb. LTCM's collapse demonstrated that leverage can be dangerous when applied too aggressively, particularly when the underlying positions are exposed to unpredictable market forces. The fund's use of leverage was not unique, but its scale and the size of its positions made its collapse a perfect storm. This lesson about leverage remains one of the most important in modern finance, as we continue to see excessive risk-taking in many areas of the market, from hedge funds to retail investing. Lesson 2. The limits of mathematical models. Another crucial lesson from LTCM's collapse was the limitations of financial models. The fund's managers had believed that their mathematical models, which relied on historical data to predict market movements, would allow them to accurately forecast the behavior of financial assets. But the reality was far more complicated. The models assumed that markets were efficient and that price discrepancies between related assets would eventually converge. They didn't account for the possibility of extreme, unforeseen events, the kinds of market shocks that can throw everything into chaos. When the Russian debt crisis struck, LTCM's models failed to predict the scale of the disruption, and the fund found itself caught in a perfect storm of market volatility. This failure highlighted a critical flaw in the way many financial institutions use models to guide their decision-making. While these models can be incredibly useful, they are only as good as the assumptions they are based on. In LTCM's case, the models assumed stability, an assumption that proved disastrously wrong. Today, the same type of over-reliance on models can be seen in many areas of finance, particularly in the world of algorithmic trading and quantitative finance. Many modern traders and hedge funds rely on complex algorithms to make decisions, but these models can't predict everything, especially when it comes to extreme market events. The key takeaway here is that no model can account for every possible outcome, and investors must be prepared for the possibility of unexpected shocks that can throw even the most sophisticated predictions into disarray. Lesson 3. The importance of diversification. The fall of LTCM also highlighted the importance of diversification in investment strategies. LTCM had built its portfolio based on a strategy of arbitrage, identifying price discrepancies between related assets and betting on their convergence. However, the fund had concentrated its bets in a narrow range of markets, including government bonds and derivatives. When these markets were hit by the Russian debt crisis, the fund was exposed to massive, unmanageable losses. Diversification, spreading risk across a broad range of assets and markets, is one of the fundamental principles of sound investing. While LTCM had built a portfolio that appeared to be low risk, its concentration in a few key markets made it highly vulnerable to disruption. By diversifying its positions, LTCM could have reduced its exposure to any one asset or market and potentially avoided the catastrophic losses that led to its downfall. In today's financial world, diversification remains a key principle of risk management. Whether for institutional investors or retail traders, spreading investments across a variety of asset classes, stocks, bonds, commodities, real estate, etc., helps to reduce the risk of catastrophic losses. The collapse of LTCM serves as a reminder that even the most sophisticated strategies can fail when they're overly concentrated in a single market or asset class. Lesson 4. The perils of too big to fail. LTCM's collapse also brought to the forefront the concept of too big to fail. The idea is that some institutions are so large and so interconnected with the global financial system that their failure would have disastrous consequences for the entire system. LTCM was a hedge fund, not a bank, but its size and influence made it a too big to fail institution in the eyes of the financial world. When the fund neared collapse, the Federal Reserve stepped in to orchestrate a rescue, effectively bailing out LTCM to prevent the potential collapse of the global financial system. The intervention of the Federal Reserve highlighted a critical issue in modern finance: the growing concentration of power and influence in the hands of a few large institutions. The fear of contagion, that the failure of one major institution could send shockwaves to the financial system, has only grown in the years since LTCM's collapse. Today, we see similar concerns about the too big to fail problem, particularly with regard to large financial institutions, global banks, and even the rise of too big to fail tech companies. The collapse of LTCM and the subsequent intervention made it clear that the failure of a large institution could have far-reaching consequences. Lesson 5. The role of government and central banks. Finally, LTCM's collapse raised important questions about the role of government and central banks in managing financial crises. The Federal Reserve's intervention was a stark reminder that, in times of crisis, governments and central banks are often called upon to step in and stabilize the system. But the question remains: when should they intervene and how far should they go? The moral hazard created by such interventions, the possibility that institutions might take on excessive risk knowing that they will be bailed out if things go wrong, is a question that remains relevant today. In today's world, central banks continue to play a significant role in managing economic stability. The global financial crisis of 2008, for example, saw massive interventions by central banks and governments to prevent a total collapse of the financial system. These interventions are essential in times of crisis, but they also raise concerns about the long-term consequences of bailing out failing institutions. The lessons from LTCM's collapse emphasize the need for better risk management and more accountability in financial markets to reduce the reliance on government intervention. Modern investing reflection. The lessons learned from LTCM's collapse are more relevant than ever in today's financial landscape. With the rise of passive investing, the dominance of exchange-traded funds, ETFs, and the growing influence of algorithmic trading, the financial system has become more complex and interconnected than ever before. The same risks that led to LTCM's downfall, excessive leverage, overconfidence in models, and the failure to account for extreme market events, still persist today. As we've seen with the rise of meme stocks and the cryptocurrency boom, financial markets are increasingly driven by sentiment, social media, and herd behavior. The fundamental lessons of LTCM, the importance of managing risk, diversifying investments, and understanding the limitations of financial models, remain critical to successful investing in the modern era. Investors today must be more cautious than ever, understanding that the same risks that brought down LTCM are still very much present in today's market. Chapter 7. Analysis of the collapse from various angles. The collapse of long-term capital management, LTCM, was not a singular event, nor was it a failure of one entity alone. To truly understand why LTCM fell, we must consider the numerous perspectives of the key players involved in the crisis. The collapse was a multifaceted event, shaped not just by LTCM's miscalculations, but by the broader financial ecosystem, including the banks that funded it, the regulators who oversaw it, and investors who entrusted it with their capital. The hedge fund's perspective: overconfidence in models and risk management. From LTCM's perspective, the fund's collapse was a result of a perfect storm: the failure of its models, the unforeseen market shocks, and its exposure to extreme levels of risk. For years, LTCM's managers have relied on the belief that their quantitative models, built on the work of Nobel laureates, were infallible. They had built a multi-billion-dollar empire by betting on the idea that markets would eventually return to equilibrium. But the market's unpredictability proved to be their undoing. LTCM's core strategy was based on arbitrage, exploiting small price discrepancies between related financial instruments, betting that these discrepancies would eventually converge. The strategy was built on the assumption that the market would remain stable and that mispricings would be temporary. However, the Russian debt crisis of 1998, coupled with other global financial turmoil, created conditions that LTCM's models could not account for. These extreme market events, dubbed black swan events, triggered massive losses that the models simply couldn't predict. The managers at LTCM were brilliant, but their over-reliance on models and historical data left them blind to the possibility of extreme disruptions in the market. By failing to account for the potential severity of market crashes, LTCM's managers put the fund in a vulnerable position, one that was far too risky given the amount of leverage they had used. The investor's perspective: the risk of overconfidence in financial institutions. From the perspective of LTCM's investors, the fund's collapse was both a shock and a betrayal. The investors in LTCM were some of the most powerful financial institutions in the world: major banks, hedge funds, insurance companies, and sovereign wealth funds. These investors had placed their trust in LTCM's ability to navigate global financial markets and generate consistent returns. At the time, LTCM was seen as a safe bet, a fund that was able to consistently beat the market by using sophisticated quantitative models to predict market movements. But as LTCM's positions began to implode, these investors realized that they had underestimated the risks involved. The fund's massive use of leverage, combined with its concentrated bets in certain asset classes, exposed investors to much higher levels of risk than they had originally anticipated. The collapse of LTCM was a wake-up call for these institutions, highlighting the danger of relying too heavily on sophisticated financial models and the importance of understanding the risks associated with high-leverage investments. In the aftermath, many investors realized that they had failed to ask the right questions about the fund's operations. Despite the presence of Nobel laureates and some of the brightest minds in finance, LTCM's investment strategies were ultimately too risky. for the amount of capital that was involved. For many of LTCM's investors, this failure represented not just a financial loss, but a loss of confidence in their own risk management practices. The regulator's perspective: failure to prevent the crisis. From the perspective of regulators, LTCM's collapse raised serious questions about the effectiveness of financial oversight. The U.S. government and regulatory bodies like the Securities and Exchange Commission (SEC) were not directly involved in the day-to-day operations of hedge funds like LTCM. Hedge funds, in general, were seen as private, lightly regulated entities that catered to sophisticated investors. However, the size and systemic importance of LTCM made it clear that the failure of such a fund could have far-reaching consequences. In hindsight, many believe that regulators could have done more to prevent LTCM's rise and subsequent collapse. The fund's massive leverage, borrowing far more than it had in actual capital, created a situation where a small market disruption could lead to catastrophic losses. And yet, the financial system at the time was ill-equipped to deal with the systemic risks posed by such large and highly leveraged players. LTCM's collapse revealed the limitations of the regulatory framework that was in place at the time. The fund was operating with enormous risk, yet there were few safeguards in place to monitor or control the amount of leverage that was being used. The regulatory agencies were reactive, not proactive, stepping in only after the damage had been done, and only to coordinate the bailout efforts to prevent further instability. In the years following LTCM's collapse, the regulatory landscape changed. New rules were put in place to monitor systemic risk more effectively, particularly in the context of hedge funds and other private financial entities. By the time of LTCM's fall, regulators had underestimated the risks associated with highly leveraged, globally interconnected hedge funds, and were ill-prepared to deal with the fallout. The bank's perspective: risk and the moral hazard of bailouts. For the major banks and financial institutions that had provided capital to LTCM, the collapse was a moment of reckoning. These banks had not only invested in the fund, but had also provided it with the leverage necessary to take its massive positions in global markets. In many ways, these institutions were as complicit in LTCM's excessive risk-taking as a hedge fund itself. Their decision to lend such large amounts of money, with little regard for the underlying risks, played a crucial role in the fund's rise and its eventual fall. The banks had an interest in protecting their own investments and ensuring that LTCM's collapse didn't send the financial system into disarray. This led to the famous bailout effort, in which major financial institutions stepped in to stabilize LTCM and prevent a wider crisis. While this intervention was successful in preventing an immediate collapse, it raised concerns about the long-term implications for financial markets. The intervention also highlighted the moral hazard created by such bailouts. By stepping in to rescue LTCM, the banks and the Federal Reserve effectively sent a message that institutions engaging in reckless behavior would not face the full consequences of their actions. This lesson, that too big to fail institutions could be rescued to prevent broader financial instability, would play a significant role in the events that followed, including the 2008 global financial crisis. The global financial system's perspective: the ripple effect of collapse. On a broader level, LTCM's collapse revealed the vulnerabilities of the entire financial system. The interconnectedness of global financial markets meant that the failure of one major player could have catastrophic ripple effects. LTCM's positions were spread across markets worldwide, from U.S. Treasury bonds to Russian debt, and its sudden liquidation threatened to destabilize entire markets. This event also exposed the fragility of the financial system, particularly in the context of highly leveraged players. The massive use of leverage by LTCM meant that a small shift in asset prices could cause massive losses, triggering a domino effect throughout global markets. The systemic risks associated with such high-stakes betting, especially by firms that were too large to fail, were laid bare for all to see. Lessons for the future: what could have been done differently? Looking back, there are several key lessons that can be drawn from the collapse of LTCM. First and foremost, the story of LTCM is a cautionary tale about the dangers of excessive leverage. The fund's reliance on borrowed money to amplify its trades created a situation where even small market disruptions could lead to catastrophic consequences. Financial institutions must be mindful of the risks associated with leverage, particularly in the context of highly interconnected global markets. Second, LTCM's collapse underscores the importance of understanding the limitations of financial models. While these models can be useful in certain contexts, they are not infallible. Models that rely on historical data and assume market stability are particularly vulnerable to market shocks that fall outside of historical norms. Investors must be cautious of over-reliance on models that fail to account for extreme, unpredictable events. Finally, the LTCM crisis revealed the moral hazard posed by government bailouts and the need for better regulatory oversight. The intervention by the Federal Reserve saved the financial system in the short term, but also raised difficult questions about accountability, risk management, and the role of government in managing financial crises. Modern investing reflection, the collapse of LTCM and the analysis of its failure from various angles, holds several lessons for today's financial markets. In an era where hedge funds, algorithmic trading, and passive investing dominate, the risks of excessive leverage and reliance on financial models still exist. The rise of platforms like Robinhood, the growing influence of meme stocks, and the proliferation of leveraged ETFs all carry echoes of LTCM's risk-taking behavior. As we move forward, it is crucial for investors and financial institutions to take these lessons to heart, understanding that risk cannot be fully modeled or predicted, and that excessive reliance on leverage can lead to market instability. In today's world, where the pace of financial innovation is ever increasing, the risks that brought down LTCM still loom large. Chapter 8. The Impact on Wall Street and Financial Markets. The collapse of long-term capital management, LTCM, in 1998 was one of the most significant events in modern financial history. While the immediate effects of the fund's failure were felt by its investors and stakeholders, the broader impact on Wall Street and global financial markets was profound. LTCM's collapse exposed vulnerabilities in the financial system that many had not fully understood, setting the stage for a rethinking of financial regulations, risk management practices, and the growing influence of hedge funds and derivatives markets. LTCM's failure sent shockwaves to the heart of Wall Street, as it was one of the first major hedge funds to publicly collapse due to excessive risk-taking and leverage. At its peak, LTCM was one of the most successful hedge funds in the world, attracting some of the largest and most influential financial institutions as investors. Its collapse, therefore, was not just a blow to its own investors, but also the financial institutions that had lent the fund billions of dollars. The effect was both immediate and far-reaching, as LTCM's holdings were deeply intertwined with global financial markets, and its failure had the potential to trigger a financial crisis. The immediate reaction on Wall Street: fear and contagion. In the days following LTCM's collapse, Wall Street was gripped by fear. The financial community was left to grapple with the realization that a fund run by Nobel Prize winning economists, supported by some of the most powerful financial institutions in the world, could fail so spectacularly. The markets, which had grown accustomed to the idea that sophisticated financial models and top-tier risk management practices could tame the volatility of global markets, were now faced with a harsh reality that even the most intelligent minds in finance could be blindsided by market chaos. The reaction to LTCM's collapse was swift and intense. Major financial institutions that had invested in the fund faced huge losses, and some banks were forced to reassess their risk exposure and reconsider their strategies for dealing with leveraged investments. At the same time, LTCM's failure raised questions about the stability of the broader financial system and the growing role of hedge funds, which were largely unregulated and operated in the shadows of Wall Street's traditional players. The shockwaves of LTCM's failure were felt in markets across the globe. The fund's positions were concentrated in key markets, including U.S. Treasury bonds, derivatives, and emerging market debt. When the fund's positions began to unwind, the resulting fire sale of assets caused massive dislocations in these markets. Bond prices fluctuated wildly, and the liquidity that had once been abundant in the markets dried up. The global financial system was put to the test, and it became clear that even small disruptions in key financial markets could have profound, far-reaching consequences. The role of hedge funds in the growth of systemic risk. One of the most significant long-term impacts of LTCM's collapse was the increased scrutiny of hedge funds and the role they played in the broader financial system. Hedge funds had long been seen as an alternative investment vehicle for the wealthy and institutional investors, but they were largely unregulated and operated outside the purview of traditional financial oversight. The collapse of LTCM brought to light the potential risks that hedge funds pose to the global financial system, particularly when it came to their use of leverage. LTCM was not alone in using leverage to amplify its trades, but its scale and complexity made it a particularly dangerous example. The fund's ability to borrow vast sums of money to increase its market positions meant that even small price movements could trigger massive losses. The fact that LTCM's failure was so devastating, and that it had been allowed to take on such large positions without adequate oversight, led to calls for greater regulation of hedge funds. In the years following the collapse of LTCM, financial regulators and lawmakers began to rethink their approach to hedge funds and the broader financial system. The fear was that hedge funds, operating with minimal oversight and using high levels of leverage, could pose a systemic risk to the economy. The lesson was clear. The growth of hedge funds and their growing influence on global markets needed to be closely monitored to avoid future disruptions. The impact of LTCM's failure on Wall Street was profound in shaping how financial institutions and regulators viewed systemic risk. The idea that certain institutions, or in this case hedge funds, could be too big to fail was solidified. The collapse of LTCM was seen as a wake-up call that no financial institution, no matter how well-connected or sophisticated, was immune from failure. But the bigger question remained: what would happen if another major institution were to fail in the future? The influence on risk management and financial innovation. LTCM's collapse also had a significant impact on the way financial institutions approached risk management. The fund's success had been predicated on sophisticated mathematical models and complex strategies that appeared to mitigate risk, but those models failed when faced with real-world market chaos. The collapse highlighted the limitations of relying too heavily on models and theoretical risk assessments without fully accounting for the unpredictable nature of financial markets. In the aftermath of LTCM's failure, Wall Street began to reevaluate its approach to risk management. Financial institutions, hedge funds, and banks started to place a greater emphasis on stress testing their portfolios and incorporating more robust risk management practices. There was a renewed focus on understanding the real-world implications of financial models, rather than simply relying on them to predict future market movements. Financial innovation also took a hit in the wake of LTCM's collapse. The fund's reliance on highly sophisticated financial instruments, such as derivatives and complex structured products, had helped fuel its success but ultimately contributed to its downfall. The collapse led to a period of increased skepticism about the role of financial engineering in markets, particularly in the context of highly speculative and illiquid instruments. However, it also sparked new waves of financial innovation, as the lessons learned from LTCM's failure forced investors to rethink how they structured their portfolios and manage their risk. The evolution of the regulatory landscape. The collapse of LTCM also played a crucial role in shaping the evolution of financial regulation in the years that followed. The U.S. Securities and Exchange Commission, SEC, and other regulatory bodies began to take a closer look at hedge funds and the growing risks they posed. Although hedge funds were still largely unregulated, there was increased pressure to create a more comprehensive regulatory framework that would address the systemic risks posed by large, highly leveraged financial institutions. The most immediate response to the LTCM crisis was the implementation of more stringent risk management requirements for financial institutions. In the years following the collapse, many hedge funds and banks were required to hold higher capital reserves to buffer against potential losses, and there was a greater focus on transparency in financial markets. In addition, the Basel II Accords, an international framework for banking regulation, included provisions aimed at improving risk management practices and ensuring that financial institutions were better prepared to handle crises. Despite these regulatory changes, however, the lessons from LTCM were not fully absorbed. The financial industry would soon face an even greater crisis: the 2008 global financial meltdown, in which many of the same issues that led to LTCM's collapse resurfaced. Excessive leverage, risky financial products, and the lack of adequate oversight all contributed to crash, raising the question of whether the financial industry had truly learned from the LTCM debacle. The role of central banks and the Fed's interventions. LTCM's collapse also had a lasting impact on the role of central banks, particularly the U.S. Federal Reserve. The intervention of the Fed in the LTCM crisis was a pivotal moment in the evolution of central banking, as it demonstrated the central bank's willingness to intervene to prevent systemic collapse. The Fed's actions to broker a bailout and stabilize the financial system were seen as necessary at the time, but they also raised important questions about the role of central banks in managing financial crises. In the years after LTCM's collapse, the Federal Reserve and other central banks around the world became more involved in monitoring and managing systemic risk. The 2008 financial crisis would further solidify the role of central banks as key players in managing financial stability, leading to widespread monetary interventions and bailouts to stabilize the global economy. The legacy of LTCM's collapse was thus twofold. It highlighted the risks inherent in unregulated financial innovation and excessive leverage, and solidified the central bank's role as the guardian of financial stability. Modern investing reflection. The lessons from LTCM's collapse continue to resonate in today's financial markets. The growth of passive investing, algorithmic trading, and the rise of cryptocurrency markets are all recent manifestations of the same dynamics that played out in the LTCM debacle. Complex financial products, excessive leverage, and interconnected markets. Just as LTCM's reliance on sophisticated models and derivatives led to its downfall, modern investors must be wary of over-reliance on models and the assumption that markets will always return to equilibrium. The financial system today is arguably even more interconnected than it was in 1998, with the rise of tech giants, the proliferation of retail investing, and the influence of social media. These trends have introduced new risks, but the lessons of LTCM, the dangers of leverage, the importance of sound risk management, and the need for regulation are just as relevant today. As we continue to navigate an increasingly complex financial landscape, LTCM's collapse serves as a reminder of the importance of understanding the full scope of risk and the limits of financial models. Chapter 9. The Conclusion and Final Thoughts. The collapse of long-term capital management, LTCM, in 1998 marked a pivotal moment in the history of global finance. The fund's failure sent shockwaves through Wall Street and beyond, revealing deep vulnerabilities in the financial system that had previously gone unnoticed. What started as an intellectual experiment, blending academic theory, quantitative finance, and high-risk trading, ended in a spectacular disaster, leaving behind a trail of lost fortunes, ruined reputations, and invaluable lessons. At its peak, LTCM was seen as a pinnacle of financial innovation. The fund had been founded by some of the most brilliant minds in finance, including Nobel laureates Myron Scholes and Robert Merton, who had developed the Black-Scholes options pricing model. LTCM's success seemed to confirm the belief that markets could be tamed and predicted with the right mathematical models. Yet, in the end, it was the unpredictability of the market, combined with the overconfidence of the fund's managers, that led to its downfall. The story of LTCM is not just a tale of hubris or intellectual failure. It is a cautionary tale that highlights the dangers of over-reliance on financial models, the risks of excessive leverage, and fragility of the global financial system. But it is also a story of redemption, of the lessons learned, and of the evolution of financial regulation and risk management in the wake of one of the most significant financial crises of the 1990s. Key takeaways from the LTCM collapse. The collapse of LTCM offers several timeless lessons for investors, financial institutions, and regulators. These lessons are just as relevant today as they were in 1998, and they provide crucial insights into how we navigate the increasingly complex and interconnected world of finance. 1. The dangers of excessive leverage. LTCM's most significant mistake was its use of excessive leverage. The fund borrowed vast sums of money to amplify its positions in global markets, believing that small price discrepancies could lead to significant profits. But when the market experienced unexpected shocks, LTCM's leverage amplified its losses, making it impossible for the fund to recover. This lesson about leverage remains as pertinent as ever. In today's world of margin trading, cryptocurrency speculation, and leverage exchange-traded funds, ETFs, the risks of excessive borrowing to amplify returns are still ever present. 2. The limitations of financial models. LTCM's managers placed immense faith in their mathematical models, believing that they could predict the behavior of global markets with near certainty. But as the Russian debt crisis demonstrated, models built on historical data are not infallible. The financial markets are inherently unpredictable, and models that fail to account for extreme events, the so-called black swan events, are doomed to fail. This lesson is vital in the age of algorithmic trading and AI-driven investment strategies. No matter how sophisticated the model, it cannot foresee every possible market disruption. 3. The importance of diversification. LTCM's portfolio was highly concentrated in certain asset classes, including government bonds and emerging market debt. When these markets experienced turmoil, the fund's exposure to them led to catastrophic losses. The importance of diversification, spreading risk across a wide range of asset classes, cannot be overstated. In today's market, where retail investors can easily invest in a variety of assets through platforms like Robinhood, the need for diversification remains one of the most important principles of sound investing. 4. The role of too big to fail. LTCM's collapse introduced the concept of too big to fail into the financial lexicon. The fund had become so large, so interconnected with global financial markets, that its failure threatened to bring down major financial institutions. The bailout orchestrated by the Federal Reserve demonstrated the risks posed by large, systemically important institutions. The moral hazard of such bailouts, the idea that institutions can take on excessive risk knowing that they will be rescued if things go wrong, remains a critical issue in today's financial world. 5. The need for regulatory oversight. The failure of LTCM highlighted the need for better regulatory oversight of hedge funds and other private financial institutions. While hedge funds had operated with minimal regulation in the past, the systemic risk posed by funds like LTCM made it clear that stronger regulatory frameworks were necessary to prevent similar crises. In the years following LTCM's collapse, regulatory bodies like the U.S. Securities and Exchange Commission (SEC) and the Federal Reserve implemented new measures to monitor and manage systemic risk. However, as the 2008 financial crisis showed, these regulations were not enough to prevent the next major meltdown. The challenge for regulators today is to strike the right balance between allowing financial innovation and ensuring that systemic risks are properly managed. The legacy of LTCM, from crisis to reform. The collapse of LTCM was a turning point for global financial markets. It prompted a reevaluation of how risk was understood and managed by financial institutions, hedge funds, and regulators. In the years that followed, new risk management practices were adopted, and financial institutions began to stress test their portfolios more rigorously. The lessons learned from LTCM's collapse also influenced the development of regulatory reforms, including the Basel II framework, which introduced stricter capital requirements for banks and better risk assessment models. But perhaps the most significant legacy of LTCM's collapse was the rise of systemic risk as a key concern for regulators and central banks. The fact that a hedge fund, largely unregulated and operating with massive leverage, could threaten global financial stability was a wake-up call for policymakers around the world. This realization laid the groundwork for the interventions that followed in the 2008 financial crisis, where central banks and governments were forced to step in to stabilize the global financial system once again. Despite the reforms and lessons learned, the financial system has continued to evolve in ways that echo the dynamics of the LTCM crisis. The rise of high-frequency trading, the dominance of passive investing, the growing influence of algorithmic strategies, and the rapid expansion of cryptocurrency markets all reflect the same complex forces that made LTCM's collapse possible. The critical lesson remains. While financial innovation can bring benefits, it also introduces risks that must be carefully managed. Modern investing reflection. Today's investors can look to LTCM's collapse as a valuable case study. While financial markets have evolved significantly since 1998, the core lessons from LTCM's downfall remain relevant. The key is to understand that the market is unpredictable, that leverage can amplify both profits and losses, and that diversification is essential to managing risk. Investors must also be cautious about the over-reliance on financial models and be prepared for the possibility of unforeseen events that can throw the markets into disarray. In the age of digital markets, where retail investors have greater access to trading platforms and investment tools than ever before, the risks associated with speculation, leverage, and herd behavior are more pronounced. Just as LTCM's managers failed to account for the extreme market events that led to their downfall, today's investors must recognize the potential for volatility and prepare for the unexpected. The collapse of LTCM was a lesson in humility for the financial world. A reminder that no model is perfect, no strategy foolproof, and no market immune from disruption. As we look to the future, the challenge for investors, regulators, and financial institutions will be to apply the lessons of LTCM's failure to an increasingly complex and fast-moving financial landscape. Closing reflection. In conclusion, the story of long-term capital management is one of brilliance, hubris, failure, and redemption. It is a story of how financial innovation, when left unchecked, can lead to disaster, and how the lessons learned from failure can shape the future of finance. While LTCM's collapse may seem like a relic of the past, its lessons remain timeless, offering valuable insights for today's investors and financial professionals. As we move forward, it's crucial to remember the risks of excessive leverage, the importance of diversification, and the need for robust risk management practices. Whether you're a retail investor, a financial institution, or a regulator, the story of LTCM serves as a powerful reminder that the market is unpredictable and that no amount of mathematical modeling or intellectual brilliance can shield us from the forces of human emotion, market volatility, and unforeseen disruptions. As we close a chapter on When Genius Failed, the story of long-term capital management, LTCM, leaves us with lessons that resonate far beyond the 1990s. The collapse of LTCM is not just a tale of the hedge fund's failure. It is a cautionary story about risk over confidence and the limits of human intellect when it comes to navigating the complex, unpredictable world of finance. LTCM's fall showed us that no matter how brilliant the minds behind an institution, no matter how sophisticated the models they create, the markets are still shaped by forces beyond even the most cutting-edge algorithms. In today's world, where digital trading platforms, meme stocks, and crypto hype cycles dominate financial headlines, the lessons of LTCM are more relevant than ever. The overuse of leverage, the overconfidence in models, and fragility of financial systems are risks that continue to linger. It is easy to get swept up in the excitement of new, high-reward strategies, but LTCM's collapse serves as a reminder. The financial markets are a volatile and unpredictable place, and the risks we take can have far-reaching consequences. As we look forward to the future, investors must remain vigilant. They must understand that no model or strategy is foolproof, and that success in the market requires a careful balance between risk and reward, confidence and caution. The rise of artificial intelligence in finance, the dominance of passive investing strategies, and the growing influence of retail investors on platforms like Robinhood are all reshaping the financial landscape. But these shifts also bring new challenges and new opportunity for disaster, if not managed properly. The collapse of LTCM was a wake-up call for the financial world, a moment where the assumptions about risk, leverage, and market behavior were tested to their limits. The aftermath of that crisis forced the industry to rethink its approach to risk management, regulation, and systemic stability. And while financial systems have evolved, the core principles remain unchanged: understanding risk, managing leverage, and being prepared for the unexpected. As you digest the lessons from LTCM's rise and fall, take a moment to reflect on your own investment strategies. Are you taking on too much risk? Are you relying too heavily on models that promise certainty, but may not account for the chaos of the real world? Are you diversifying enough to shield yourself from unforeseen shocks? These are the questions that today's investors must ask themselves every day. We hope this deep dive into LTCM's history has offered you valuable insights, not just into a fund collapse, but into the timeless lessons of risk, leverage, and financial discipline. The story of LTCM isn't just a historical event. It's a mirror for the financial world we live in today, and its lessons are ones that every investor, no matter their experience level, should take to heart. If you found value in this breakdown of When Genius Failed, make sure to subscribe to Capitura, because next, we'll be diving into another classic that could change how you think about money, investing, and the markets. Stay tuned for more in-depth analyses and educational content designed to help you navigate the complexities of the financial world with confidence. Remember, investing is not about guessing the next trend, but understanding the core principles that guide all financial markets. At Capitura, we're here to break it down and help you invest smarter for the long term. Don't miss out on the next episode. Hit that subscribe button and stay tuned for more insights that could shape your financial future. This concludes a full breakdown of when genius failed. If you're ready for more content or have specific questions, feel free to reach out and let's keep the conversation going.